The biggest crooks are on Wall Street. They are the biggest banks. They're J.P. Morgan, Goldman Sachs, Wall Street. But that's not capitalism, that's criminal. I went into investing in real estate. The reason I like real estate is because I can use debt. You know, debt is tax-free money. I know everybody says get out of debt, but you have to know what you're doing. I don't recommend it, but I borrow as much as I like because it's tax-free. Let's say I borrow $1 million. It's a tax-free $1 million. If I had to work for $1 million, it cost me $2 million because I have to pay the taxes on it. So debt is tax-free money, and with that, I buy real estate. So what happens here is the relationship, as you can see this chart here. You have bonds like U.S. Treasuries, and then you have stocks, something that's called equities. So what happened was when Nixon took the dollar off the gold standard in 71, remember 71 was Nixon taking the dollar off the gold standard. 72, Nixon went to China, which opened the door for Walmart shoppers and Amazon. And then all these things started to happen. So the U.S. economy started to sink because the Chinese were producing better products at better prices. And then a guy like Clinton opened the Chinese door to the WTO, the World Trade Organization. So what happened when I was in my 20s, because the economy was stalling, they had to start dropping bond yields. So my numbers are probably off because I don't really like bonds. But let's say back when I was getting into the workforce, you could get 16% on a bond. So if you put $1 million or 100,000, whatever it was, you got 16% on your money. But as the economy slowed, they kept dropping the bond prices. They wanted to drop debt, make it cheaper. Then what happened is that the stock prices higher. So that's macro. That's the relationship between bond prices coming down and stock prices going up. So after 2008, what they call the GFC, the Great Financial Reset or whatever they call it, they had to keep dropping bond prices lower and lower and lower, and it got near zero. So they call it zero bound. So in some countries in Europe, you know, if you have $1 million, you put it in a bank, they charge you money for there's no interest in it. So that's why Rich Dad, Poor Dad came out in 1997. I said, savers are losers. The reason I said that was interest rates on your savings was going down. And they're printing more and more money on the macro level. And what happened is then these companies like the Fortune 500, they were borrowing cheap money to prop up their stocks. So they were buying back their stocks, which sent the stock price higher. The stock market is at an all-time high. Bond prices are about, I think the 10 years about 1.5%, so it came up just a little bit. This affects the whole economy. So it's going to be one of the biggest problems the world faces, is our pensions have been stolen. If the government promised my dad $1,000 a month, they had to give him the $1,000 a month. And then something happened in 1974. It was called ERISA. And ERISA stands for Employee Retirement Income Security Act. And today it's called the 401k, the IRA, the Roth IRA, a SEP, KIOS, and all this stuff. And when it shifted from defined benefit, which is a guaranteed set amount, then in 74 it shifted to defined contribution. So when this gentleman said, I've been driving the bus for 40-something years, he's about my age, and I'm going to retire, I said, oh, do you have a government pension, defined benefit? He says, no, I have a 401k. It's not that it's bad, it's horrible. That's the problem with it, because if the stock market crashes, this bus driver who's about my age gets toasted. He gets wiped out. He says, don't worry. He says, I know what you're saying, you know. I know the stock market is way up there, so I shifted into safety. I said, ¿Qué pasa? What did you do? He says, I shifted into bonds. I went, oh. If the bond prices go up again because they got too much inflation, And I'm not saying it's going to happen. It's either going to inflation or deflation. We don't know. I don't know. But let's say they raise the bond price, stock market crashes, okay? Because the companies like Ford Motor Company, IBM, and those guys, the price of their debt goes higher. They're so deeply in debt because they've been borrowing from, let's say, IBM's treasury, and they've been buying back their stocks so their executives can parachute out with stock options. So the CEOs and the executives of these major corporations in America have been screwing everybody because they were borrowing money from the company to buy back the shares of their stock because the price of money was so cheap. But it drove the stock market to all-time high. So today, of the S&P 500, sort of the benchmark of how good the economy is, of the S&P 500, 100 or 20% of the S&P 500 are zombies. In other words, their debt is so high because their stock price is high, but they kept borrowing money to prop up the stock market. So what you're looking at here is kind of a mini, micro, macro look at the world. So let's say they raise the bond price. Okay, so let's say they go from 1.5% to 3%. 100 companies crash. Of the Fortune 500, they crash because they can't make enough money to pay off the debt they borrowed. So their CEOs and executive vice presidents and all the investors can parachute out, screwing the stock people who invest in the stock market. That's why I don't own any stocks. I don't.